Welcome to the daily update, where I'll go over the action in the market for Monday, July 1st, and then we'll see how things look for Tuesday, July 2nd. We had an up day, not a real strong day. We're still seeing some weakness coming into the market. We're still positive, though, in the short, intermediate, and long term, but we're looking more and more vulnerable. Now, this is going to be a holiday shortened week. The market's going to close early on Wednesday. It's going to be completely closed on Thursday. And then we're coming back to the big employment situation report on Friday. So we kind of have like 3.5 trading days this week. A lot of folks will be taking off early. So maybe it's only 3 trading days. So volume has been dropping off. Not a real surprise there. There's a lot going on, especially in the US right now, concerning the presidential election, and a lot of focus is on that, but it's not really having a direct impact on the markets. Now, there are some exceptions to that. We're seeing some shifting going around in the bond market. Maybe interest rates are starting to go back up. That may be on the negative side in anticipation of an increase in inflation. On the other hand, that could be positive because that could also suggest economic growth. We'll have to watch to see how all of that plays out, to see if things do change as far as the election is concerned, and then what the stock market is and all the financial markets are figuring will happen economically going forward. Before I get started, I do have a thing called the SPXInvesting Program. It's launched. I'm trying to lock it down a little bit more in July. At the time I record this on July 2nd, it's still pretty much wide open. There's some additional things that I want to roll out during the month of July. I'm trying to set things up, and it's a little more complicated. I still want to keep it free for right now, but I want to lock it down in the sense that not anybody can just come and look. You need to supply an email address in order to do that. Feel free to check that out. I do have one new thing that I've been posting there, are just some suggestions based on what's happening from a technical analysis perspective. And then these are positions that you may consider. Now, you may do things completely different than I do. The foundation of what I do is analyzing things from a technical perspective, and then I do pretty conservative strategies. But if you don't know these strategies, they're not necessarily considered conservative. So there might be a learning curve that's involved in this whole process. If you want to learn more about the program itself, there is a link below this video that you can click and go. I'm hosting this on Substack, and there's also a link to other videos. There's a playlist on YouTube, and there's other videos on Rumble that go into more detail about the program. And if you have any questions, or you want to talk about it, or you want a more one-on-one type explanation, here's an email address where you can contact me. We can back and forth by email, we can message, we can even set up a time to talk either on Zoom or Skype or Messenger or something like that. And I keep having to clear my throat here. Just to give you an idea, I had some questions over the weekend. It's like, well, this intermarket analysis video, that's all great, but what's the point? Well, I try to stress this, probably not as much as I should, but to me, everything comes down to the daily video. All the other videos that I do, the weekly video, the intermarket analysis video, deep dive, and what to watch video, and as well as any supplemental videos, which from now on won't be public. I'll be diving into some topics that I'm going to keep within the website for the program members. And I want to do videos on, like, what is ESG? What's that all about? What's this whole thing about the petrodollar? What's going on in France right now, considering their election? Things that are kind of outside the scope of what we talk about as far as the stock market is concerned, but still relevant to what's happening. And what's the presidential election looking like? Just things like that. And I try to take a real neutral approach in these videos, and that's what an educator should do. Here's the positive, here's the negative, here's the good, here's the bad. Now you reach a conclusion yourself instead of trying to indoctrinate people with what I think is the right answer. A real educator just lays everything out and lets the people that are taking this in actually decide. So That's why if you're running across my channel for the first time and you maybe stumble on the deep dive video and you're like, what does this have to do with anything? Or what about this intermarket analysis video? It all feeds into the daily video because that's the real foundation of my analysis. Okay, right at the open, what we did have is a higher open and prices then quickly fell. We went down below the unchanged level and we found support at a nice round number at 54.50. Then we rebounded up off of that. We got above the unchanged level, so we went positive, but then we just chopped sideways. There was really no conviction going on. We chopped along the 54.70 level, and then we just closed. We hit the daily pivot. That was the high point of the day at 54.78, but we closed just a little bit below that. We were up 0.27% on below average volume. It is a holiday week, so we might see volume taper off. But then we've got some really big things happening economically as far as reports. But like on Wednesday, the Fed meeting minutes are going to come out, but that's after the market closes. So, and then we're going to be closed on Thursday. And so some of those reports are going to be punched back to Wednesday, which is a shortened day anyway. And then we're going to have the big report on Friday. So it's really kind of a crazy time just for the stock market itself, let alone all the other stuff that's going on. So we are positive for right now in the short, intermediate, and long term, but we are seeing some weakness coming into the market. There's not an awful lot of confidence right now going on, and we've just been chopping sideways. Yeah, we had an up day, but we're not seeing any real under the strength conviction going on right now. And as this week plays out, hopefully we'll get a little bit clearer picture. It's never quite clear, but we just watch this story unfold as it applies to inflation and interest rates, and then the geopolitical things that are going on. And I don't have what's going on in the US listed here. That's really the talk of everything these days. We'll just have to see how that plays out. But unless something really drastic happens on either side, it's probably not going to have an impact on the markets. And if something drastic like that does happen, it typically won't last that long of a time. So we just kind of roll with what's going on because we're still looking okay with our charts. It's the sentiment is now starting to shift. It's like, oh my gosh, things aren't going in the direction that we thought they were going to go. They might be changing, and there might be changes sooner. There might be changes later. There's other events that maybe we haven't anticipated. And so folks are kind of focusing in on this because we are in an election year. Some comments. The NASDAQ did close at a new all-time high. I mean, it's like, how can you say weakness is developing when we're hitting all-time highs? Well, we were seeing that back in the year 2000 too, but we're not seeing what's called necessarily a blow off top, where everybody's just throwing money to the market and it's going up and up and up because they're afraid of missing out. And then we hit some kind of an ultra high point and then start to reverse from that. We're not seeing that at this point. We're seeing, if anything is starting to develop that looks weak, it would be more rounded. It's more under control, so to speak. So if we do see some weakness from here, until proven otherwise, it looks like it will be just a decline. And then if we continue to drop below the 20-period moving average, then it'll turn into more of a pullback, or you can throw those words around. Usually when it's just a little bit of a down day, I say pullback, then a decline is when we go under the 20-period moving average. Then it's going to get a little more severe if we end up falling below the 50-period moving average. Now, we don't know if even something like that is going to play out. We just need to be thinking ahead to see these possible scenarios. But in Monday's session, the mega caps outperformed, and that's really what's been keeping the market together. This weakness continues to develop, and as I get into the charts, I'll show you that. And this is a big one to me. This is a primary indicator that I use, and the parabolic SAR has turned negative. Now, it was pointed out to me by somebody else's chart that's a member in the program that their parabolic SAR chart had turned negative after Friday. When you look at the SPY, and I looked at my SPY chart, and I didn't see that. But I did see it on the 2 times ETF. Now, some of you are going to understand what that means. Some of you may not. It's an enhanced or leveraged ETF that if the S&P goes up 1%, this ETF goes up 2%. The parabolic SAR chart did turn negative on that chart, but I don't use those to do deep technical analysis because there's some skews between ETFs and the indexes that they track. And so I like to keep it a little bit more pure. Just to let you know, on the 3 times leveraged ETF, the parabolic SAR chart did not turn negative after Friday. Now we're turning negative on the daily chart with the S&P 500 itself, and that is a pretty big sign. On a short-term basis, we still have our stochastics that are looking extreme, but they are rolling over, and we're still looking extreme negative already with the Stochh RSI. That's a short-term, really touchy indicator. The scenario hasn't changed. We'll see. With the meeting minutes coming out, is this scenario going to look any different? Where the Fed's keeping rates higher for longer, inflation hasn't been coming down as fast as they would like. They are looking at possibly 1 rate cut, and the market's still anticipating that for September. Now, that's what the market's forecasting, but they were also forecasting 6 rate cuts at the beginning of the year. Then it was 4, then it was 3, now it's down to 1. We don't even know if we're going to get any, but the market likes to front run these things and work these scenarios. The dollar was up and interest rates were also up. This put some pressure on stocks. We closed at 4.48% with the 10-year yield, where after Friday we were at 4.34%. We're still inverted with the yield curves, and sentiment is now ticked up a little bit. We've gone back into neutral where we had been negative. We came in at 44 after Friday. After Monday, we've risen up to 48. We are still in a trending environment with the ADX is going up. And strangely enough, even though we've been chopping sideways, the ADX is getting to kind of an extreme, at least close to an extreme positive reading. And I'll show you that chart. With the up day, our bias is positive, and that's usually what I do. If we have an up day, positive, down day, negative, there are some exceptions to that. And then momentum is the last 2, 3, 4, 5 days taken together. I'm still keeping that mixed for right now because there's just no conviction. The economic reports came out. The big one was the ISM Manufacturing Index. The takeaway from this is we're below 50. We came in at 48.5. When we're under 50, that shows a contraction in the manufacturing part of the economy. They expected 49.1, so this was weaker than expected, and it was actually down a little bit from the last reading at 48.7. Construction spending was down 0.1%. They expected it to be up 0.1%. Last time it was up 0.3%. This one isn't as influential, the U.S. manufacturing. This is global. And even though it's important, it doesn't have a real impact on U.S. markets. Now, this one, we're above 50. We came in at 51.6, where last time it was at 51.7. So on a global basis, we're still showing slight expansion. Here are some charts. Here's the ISM. The blue line is the total reading here, where it has been declining and we're below 50. The orders are starting to go up, and that could be taken as somewhat positive. And then the ISM prices and deliveries, the prices are coming down, and that helps more with the inflation things, where deliveries are actually going back up a little bit. So this is taken a little bit more friendly. And then the ISM trade, when we look at imports and exports, the imports are going down and the exports are going up, which is kind of strange since the U.S. has switched over to a different kind of economy where we're more service-oriented instead of manufacturing-oriented. This is why we typically see this declining on a bigger long-term scale. Here is the change showing where we are still below 50 with the ISM itself. Construction spending did decline on a year-over-year basis. We're still above this 5% level, but it's coming down. And then looking year over year, we look at residential versus non-residential. The residential did decline. That's the blue line, where we were flat with the non-residential. And then month over month, construction spending actually did decline after it had been above 0 for the last number of months. Here's some Isabel Net blog charts. It says a lot of new highs suggests more new highs are coming. It's just positive breeds positive, negative tends to breed negative. So we're looking here at, I mainly focus here on the bottom area, not so much all these crazy little numbers here. But we have an average return from 3 months and then the rest of the year and then the full year. Now, we don't know what's going to happen going forward from right now, but we're typically up 0.9%. 3 months later, 5.7% for the rest of the year. And for the full year, up over 20%, which would be a really nice return. And then here's the median as well. 3% in 3 months, 9.6 for the rest of the year, and 19.5 for the full year when you take it all together. And then here's the average that we're looking at down below here, where 0.6, 4.8, and 9.3, the further you look out, the better it is. And the median also 2.4, 5.6, 12%. And then how much we're up, 60%, 71%, and also 71% going forward. So the odds are in favor of the market still continuing to be strong. Even though there's all these different forces that are acting upon it right now that could end up dragging things lower, that's what we'll be watching. If we do see some kind of a pullback or a decline, what's that doing to the bigger picture while this is unfolding? Or we're just going to continue to go higher, but we're worried about these weak areas that we're starting to see. This is interesting. This is the destocking cycle. Apparently it's Christmas time and they don't let you put up stockings anymore. But this just gets to a really low reading, typically either at the end or right after a recession, and then we see a nice bounce. We're getting a very low reading right now. This could suggest some economic strength going forward just by looking at this chart. And then we're seeing a lot of money going out of energy right now, and folks are taking some profits with that. And then the yen seems to be in more or less a free fall when compared to the US dollar. You want to go somewhere and get a pretty favorable exchange rate, you might consider going to Japan. Where the yen's going down, that means the dollar is going up. So you get a better conversion rate there. And then are you likely to increase or decrease your equity exposure? Now there's two ways to look at this. One is negative. A lot of folks, 65% say, oh, we're going to decrease our exposure to stocks. And if that's more the sentiment, then that could take things lower. On the other hand, that means 65% are not expecting the market to go up, and the market quite often will defy human logic in place of its own logic and end up going up and then prove a lot of these folks wrong. So again, you have to look at a lot of these charts in two different ways. They're not really black and white in and of themselves. And looking at the second quarter earnings per share growth estimate, it's up 9%. And look at the blue dots here. That's really what we're following. These are the actual ones. And then forecasting going forward. And this is earnings per share going up on a relative basis here. And that helps the market to go higher. And looking at breadth, this is something that's been a concern that I've been watching and really bringing up here. This is Goldman Sachs, where this was after Friday, where we're seeing breadth is just not very strong right now. This is showing that there's not an awful lot of broad participation in the market. And we saw that more on Monday. I do have a number of charts from Twitter, but it's kind of dealing with the same basic topic. There's a few exceptions here. Stock volume explodes outside regular trading hours. I thought this was kind of humorous because it's like, well, maybe we could all just take the day off and sit at home in the evenings and work the stock market then. But we're seeing an awful lot of pickup in volume that takes place when the stock market is closed. It's open 24 hours a day, 6 days a week. It closes on Friday and then resumes Sunday afternoon, depending on where you're at in the US. It's afternoon or evening. And we're seeing a real pickup. Now they don't have it on this chart, but that became kind of the cool thing to do back during the dot-com boom and then bust. I don't necessarily think that this is a real advantage for folks to focus more on pre-market and aftermarket transactions. You're not going to get as favorable bid and ask spreads during that time. Volume is up, but it's not nearly as high as what we see during the regular session. But it's something still to take note of. Then I have a number of charts here from Real Investment Advice looking at consumer confidence, where it says stock prices. If you ask people, hey, what's the stock market going to do? They're really positive about that. But when it comes to, are we going to have a raise here in the next 6 months? No, this is actually starting to go down. And then jobs not so plentiful. Okay. And we know the employment numbers that we get are not necessarily realistic of what's happening, but it's what the market uses, and it's what the market reacts to, and it's what the Fed uses, and it's what policy uses to justify what it's either doing or not doing. But this is just saying, okay, yeah, it's not as high as what it may be projected in some other reports that we receive. And then this is the composite, the consumer confidence composite taken together, and then some historical events. Again, you might want to pause this and look. Of course, this is when it's going down, people are not feeling good about things. We're continuing to go down here, even though the stock market has been going up. So we're seeing a bit of a disconnect there. And then these are the different measures. This is comparing consumer confidence, which is in black. And that's the report that we got last week. And then on Friday, we got consumer sentiment. They call it University of Michigan consumer confidence. I refer to it as consumer sentiment, where we're going down when you take both of these together. People are not feeling as optimistic about things. This is a little bit of a change, but it's still from Real Investment Advice. This is looking at analyst estimates over time and how they've been going. I follow the red line, and you can track different dates and what was happening and so forth. So some reports that we get show earnings per share going up into the future. Well, these estimates are actually coming down, and that could put some pressure on the market. All right, here's our intraday chart. Really choppy day, especially right off the bat, where we did have a higher open based on Friday's close. We got just about up to the pivot, and then that was the high, at least for the early part of the day. Then we started to fall back, dropped to negative. We found some support here at 54.50. Then we bounced back, went positive, and then just chopped sideways. Tried to break out, but came right back down. And then we did hit the daily pivot again going into the close, but we closed below the daily pivot. Here's the intraday chart. Not really much here. We were pretty much flat as we were leading up to the cash session, and we're down a little bit now in the initial overnight session. But we are still looking good this way. The intraday chart of growth versus value still has the blue line above the red line. That is positive, and we're going up with the growth to value ratio intraday for the S&P. That is positive. Our end of day chart showed where growth was up, where value was down. Growth was down more with the mid caps and down, but down less with the small caps. So we're not really seeing much of an improvement when we break it out and look at the small caps end of day chart. The mid cap end of day chart, a little bit of a tick up, but not much of an improvement there. This is what I'm focusing on, and this applies to the S&P. We're hanging in there for right now when we look at the growth to value ratio end of day chart. And when we look at the ETFs, we're going back up here. We're above the rainbow and going up. So that's still holding up for the time being. This is not really helping things, though. Discretionary was down. Staples were up. And so we saw this ratio going down. Now, this ratio isn't really falling apart, but it's not breaking out either. The strength that we've been seeing is not because of discretionary. It's because of the weakness that we've been seeing in staples recently. The large cap growth, set a new intraday high here, but not an all-time closing high. Still holding up for the time being. The large caps actually outperformed. On Friday, we had the rebalancing of the Russell 2000 index, and that kind of blew that thing all crazy with massive volume and some gains there that seemed to be given back in Monday's session. But we're still seeing where the large caps are outperforming. The Wilshire chopping more or less sideways, up just a little bit. And we look at our trend, not so much here on the intermediate term chart. This still suggests that we are in a strengthening trend. The green line's on top, but it's coming down. And it's like, okay, after Friday on a down day, it was starting to go up. Now we have a slight up day and this goes down. So that's just showing some of the real non-conviction that we're seeing currently. This is where we're possibly seeing a bit of a warning sign. The ADX has been going up, even though the S&P has been chopping sideways. We're getting into this 40 area now. Now, with the short-term indicator, we can go well above 40. We just want to make note of that, meaning that this is kind of getting extreme positive for the time being. Volume was below average, but it has been above average for the last number of days. Here's our weekly look at the sentiment gauge. We're coming in at 80.36. We're still in extreme greed territory. We would say extreme positive, according to the way I look at this. This other sentiment indicator is coming right back down to this dashed line. We're just coming down from being extreme positive. And then we have the insider transactions ratio. It's coming down a little bit, but above this black line, which could be slightly bearish. And here's the chart, and I show this once a week. This is the insider buying ETF. We're really not doing all that much. You could make a case for some kind of a triangle type thing going on here, but we're really not breaking out, but we're not breaking down either. The Ulcer Index continues to be below its moving average and is going sideways. We don't get another reading until this week for investors' intelligence. They're still looking positive here. The VIX did decline on a closing basis. We're still getting very low readings with the VIX. We actually spiked up as we were going down with the VIX on the bar chart, but then ended up closing pretty much at the low. And since we had an up day, we declined with the VIX of the VIX, both with the bar chart and the line chart. And we haven't quite crossed over yet with the momentum of the VIX as measured by the MACD. We've been chopping around quite a bit sideways. It wants to cross below the moving average, but hasn't quite done so yet. The equity put call ratio did decline. It was up after Friday, possibly some weekend hedging that was going on. So now it seems like we're flopping back and forth with this chart. Now the 5-period chart is starting to go back down, which could be more positive for stocks. The volatility risk premium, this is just going really, really high right now. So our VIX is low, but another sentiment gauge that we look at here is the volatility risk premium. This is getting very, very high right now. And also another contradiction is this fear gauge is going up while our other fear gauge is going down. Our advanced decline line studies, we're still seeing a negative divergence here. We were up with the S&P, but we declined based on price. We're hanging in there. Here's the positive side. We're still hanging in there when we look at this based on volume. And we did see a drop off, but still more new highs than new lows. So we're starting to go back up with the 5-period and the 10-period here, but we are dropping off for the time being. It's not negative, but it's not showing an awful lot of strength either right now. And we're looking more negative here with our advanced decline ratio. We dropped below 0 with both the blue line and the red line. And I added something new here. I've been complaining lately that wouldn't it be nice if I could measure the distance the accumulation distribution is above its moving average? And I'm thinking, well, that's what you do with the boom indicator. Why don't you just set this up the same way? And that's what I do down below. That's what this measures is when we're above 0, that means we're above the moving average. And this measures how far away we get from that moving average. And when we do get up, and I just have this arbitrarily set at 100 on the upside and minus 100 on the downside, that's when we start to say, well, maybe it's getting kind of far away. So instead of eyeballing this and going, look at how far that is from there, now we can actually quantify that and qualify it a little bit by saying, yeah, it is kind of getting far away here. Maybe we're due for a bit of a pullback. But when we look at the accumulation distribution by itself, we're doing okay. This was up with the up day, and we're above the advancing moving average. But we're seeing some weakness here with the Chaikin money flow. We're coming down, even though we're positive, but the red line, the moving average, is also coming down. And we're coming down still with the Chaikin oscillator. We're still holding up, even though we dropped below the moving average with the cumulative NYSE advanced decline line. We're still looking at being above the moving average with our regular NYSE advanced decline line, and we're still above the moving average with this advanced decline line too for the NYSE. When we look at common stock based on price on the NYSE, just kind of chopping around these days and just kind of chopping around, not really showing any conviction based on volume either. This is encouraging. We're falling a little bit here with the cumulative S&P 500 based on price. We're still holding up based on volume. This isn't necessarily falling apart yet, but we're seeing more of a divergence here, negative divergence, where we've been going sideways with the S&P. We're starting to show some more weakness again with the equal weight S&P, and we're not really seeing any strength here with the advanced decline line studies. We're declining with the NYSE common stock. The S&P is now dropping below the moving average. We're declining with the mid caps and the small caps, and both of those are below their moving average. Here's the daily chart, and I don't know. I'm trying to turn off this crazy little thumbnail thing. Zoom did some kind of an update over the weekend, and their whole interface is different, and things that weren't there are suddenly there again. So bear with me as I'm trying to figure out what they're thinking. But not really showing any conviction here as far as any kind of price movement. We're below resistance, but we're still above support on this chart. If we do start to fall, we'll be watching this pivot level. We'll watch the 20 period. This is the 50-period moving average. And I'll probably extend this trend line at some point to see if that gives us some kind of support. And then on the bottom, we were below average with volume. We're still extreme negative with the Stochk RSI. We're still extreme with the stochastics. Now, we're not extreme in the short term or intermediate term. We're coming down, but still extreme in the long term stochastic. And I like to point this out. This is not short, intermediate, and long-term in the traditional sense. This is a further subdivision of the short-term time frame. Then looking at our 20-period double and triple exponential moving averages, we're dropping below the lines. The longer we stay here, the more we might see some kind of a rollover. We need to get back above both of these lines to have them keep going up. But we're still positive for the time being. But we declined with our 20, 50, and 200-period moving average studies, even though the S&P was up. We slipped back and went slightly positive with the force index. After Friday, we had dropped slightly negative. And these moving averages, the 20 periods, they're still hanging in there. If we see more of a decline, are these moving averages going to provide some support? If we can stay above this, these lines will keep going up. We're not really extreme right now. We're a little bit into the +2 channel with our standard deviations chart. We really only consider this extreme when we get into the +3, this top purple area. Then we are declining, but still positive with the balance of power. We're turning more neutral with the go, no go with the light shade of blue bars. And we're going sideways with the highest high value, but we're still above the midpoint, which means the midpoint is still going up. The TTM squeeze, seeing a little bit more weakness here. We're starting to decline, and these bars are turning to a darker shade of blue. Then we look at our 50-period double and triple exponential moving average study. We're right in between both of the moving averages currently. To be more positive, we want to bounce and get back above this. If we start to fall below it, that could suggest some weakening coming into the intermediate term trend. And we are declining, but still positive with the ease of movement. We're positive here with the Erin indicator, but we're negative here. And this is one of the negative divergences that is causing us some concern. The McClellan oscillator for the S&P is already below 0, so it's negative and declining, even though we had an up day. So this is a little further out. The summation index based on price and volume continued to decline. We're also back to negative. We were just barely positive after Friday. Now we switch back to negative after Monday with the NYSE McClellan oscillator. So we're back to declining with the summation index based on price and volume. We're turning more negative here with the Swenlin trading oscillator. We dropped below 0 after Friday. We're continuing to decline here. We were barely positive after Friday based on volume. Now we're starting to drop negative. And we're rolling over here because there's been no momentum. And so our momentum oscillators are like, I'm just going to kind of go sideways for a while. So that's what the PMO is doing. We're not really showing any strength here based on price. We're still negative based on volume. So when we look inside of the S&P with our PMO, we're declining with the PMOs that are rising. We're starting to tick down with the buy signals, starting to see more of a decline with the PMOs that are above 0. And we continue to be neutral with the Elder's Impulse system for the S&P. This is a biggie. This is the parabolic SAR. We had just enough of an intraday decline to put the dot on top. And so personally, I think this is kind of a big deal. The slope oscillator, after being extreme positive, is now rolling over and below its moving average. That's turning negative. And the MACD is also crossing below its moving average. The slope is short term, where the MACD is more intermediate term. So looking at all of our oscillators in the short, intermediate, and long term, we're starting to see some weakness as far as momentum is concerned, but we're still above all the moving averages plotted on this chart. And we came back down with the bullish percent index. That's not showing a lot of confidence either, but we're still above 50, so it is positive. We're declining, but still above 50 with the NYSE bullish percent index. We decline with the NASDAQ 100 bullish percent index, but we're still positive. We're dropping below the midpoint, or 50 now, with the money flow index. And this is interesting. After Friday, we went negative with the ultimate oscillator. We actually ticked back up and went positive again. The vortex, another primary indicator. The green line's on top, but it is declining, not showing an awful lot of confidence there. The RSI is no longer extreme, either in the 14 or with the 9-period study. We're still above an advancing moving average with on-balance volume. This is one of the newer, or I shouldn't say that, one of the oldest indicators and one of the first ones developed by Joseph Granville. He just says if we have an up day, all the volume's positive. If we have a down day, all the volume's negative. Now, and for a long time, I didn't use on-balance volume just for that reason. It's not that cut and dry. But there's a lot of indicators that are based off of the on-balance volume indicator. So that's why I show it on the video here. And we're looking negative here with the 20 periods dropping further below 50. We're also going down with our 20 period moving average steady, and we're dropping more below the 50 period moving average. That's also dropping below 50. And we're dropping below 50 with the 100 period. We're declining, but still well above 50 with the 200. We're starting to turn negative with the Copic curve. Pring bottom fisher for some reason is generating a buy signal. All right. We're dropping, but still positive with the Sean trend meter. And we're still negative here. This is a 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE. We continue to be below zero. And then looking at our longer term chart, this is positive, longer term positive for the time being. We are still above this R2 level, which is at 54.51. And I think I said it incorrectly in the daily video for Monday that we were 19 points away after Friday. We were actually 9 points away. Now we're at 54.75. So we're 14 points away. Or are we 24? I'm not a math teacher, all right? Even though I used to teach math. All right, but we're still above this. That's kind of the takeaway from this right now. And just in case we start to see some weakness, I do have the fib retracement levels ready to go. Going back to the all-time high, this was an intraday high that was set on Friday, even though we closed at the low. If we start to fall, we're looking at the 38.2% retracement level being right back down around the 5,000 level. It's marking it here at 49.82. So you can kind of look at the 5,000 level as being potential, even if we get that far. Then looking at the fib extensions, still below this 50% extension rate based on the SPY. And then I'll show the QQQs later, where we're just chopping sideways with the Heiken Ashi. We're actually turning, it's really hard to see, but this is now turning red with the Kigi chart. That's turning negative. But the Renko chart is still thinking that the party is going on, and the 3-line break is also partying on late into the night. Then looking at a long-term chart, we're still seeing this longer-term negative divergence between the 150 and 200 and what the S&P was doing, but they're not extreme right now. And then looking at the short term for the mid caps and the small caps being negative, everything else is still positive. Look, and let's see. Okay, we have the same thing twice. I didn't switch out the other chart. Sorry about that. We're still looking okay here with the decision point scorecard. And we had a real mishmash of different signals that were generated. Some were positive, some were negative. So we're seeing a real Christmas kind of red-green type of day going on here. Some things were good, some things were not as good. Sectors. The sectors that we want to do well, if we're in a positive environment, did do well. They led. Tech and discretionary were at the top of the list. And then all the other areas ended up being, well, I shouldn't say that. Financial and energy were up. Then all the other sectors were down. And we're looking a little positive here, and we continue to be positive with the new highs minus the new lows for the NYSE. We're at 14, so we're above zero. This is where we're seeing some negative divergences between the S&P bar chart and the red line, which is the S&P equal weight. And so when this is really skyrocketing up like it did on Monday, that means the mega caps are outperforming. The Dow kind of chopping more or less sideways, but still above its 50-day moving average and still above this pivot point. The diamonds continue to be neutral. The NASDAQ still having a really difficult time breaking above this pivot point here. We did on Friday, but then we came back down and closed below that. And this was kind of near where we closed on Monday for that. We want to be able to get above that to be more positive. We also want to get above this pivot point here with the NASDAQ 100 as well. And we still remain neutral for the QQQs when looking at the Elders Impulse system, but the momentum for the NASDAQ 100 is now turning negative. And here are the fib extensions for the Qs. We came up to this 38.2 projection level. We just about hit that level. Almost came up to it again on Friday. Even though we were up, we're still a ways away from that for the time being. The small caps, of course, they had to be down since they were up on Friday. And I don't mean to be cynical about the small caps. It's just I don't trade this market. I don't do the index. I just keep an eye on what's happening. But I know a lot of people that watch these videos do the small caps. And this has been a very frustrating year. I've heard from a lot of you saying, man, this really sucks. Then we are now negative with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, starting to drop below 50 with the RSI. We fell below the 50-day moving average. We're still in a longer-term uptrend. We're trying to gain some positive momentum here. We'll have to see if that's going to lead through to anything. The mid caps also another frustrating area, at least going back to the beginning of June, where they've been just chopping sideways, where this was one of the more market leaders earlier in the year. We fell below the 50-day moving average. We're below this pivot point. And we are negative with the mid caps when looking at the Elder's Impulse system. But when we look at all the stock market together, we're just coming off of recent all-time highs. Apple ended up being up 2.91%, but not, it might be a closing high there, but not necessarily an intraday high and in an uptrend. Tesla was up over 6% and was able to get back above its 200-day moving average. That would really help things in the discretionary area. If we could see some more follow through with this and not just some immediate profit taking, just see this start to go back up and eventually see a golden cross here. But that's way too early. We're just watching to see if something like that will happen. NVIDIA was up 0.62% and still looking pretty solid after some recent pullbacks. Microsoft setting an all-time high, up over 2%. Meta was virtually unchanged, but still looking solid. Amazon coming off of an all-time high here, up over 2%. Google was also up 0.5% and still looking pretty solid. Netflix was down slightly, but just coming off of recent highs, but not all-time highs. And the FANG index closed at its high, up 2.26%. So that set another new all-time high. And the financial sector still hanging in there. We're just kind of dancing along the 50-day moving average. And we're still seeing this ratio going down, and that's positive. That means the staples, things you have to have in a more defensive area, is underperforming tech, which is the growth area. The dollar ended up being up and is in an uptrend now, getting up into the high 105 range. And we're seeing a little bit of an improvement here when we look at the S&P, that's red, compared with the world index, that's black. So the 10-period correlation is starting to get stronger, but the longer-term correlation based on 50 periods continues to decline. And we look at the staple sector, still coming down and dealing with its 50-day moving average, seeing a bit of an improvement with the relative strength and momentum ratios. And utilities also breaking a bit below their 50-day moving average, showing some relative strength underperformance, but the momentum is still showing some improvement. Real estate, another defensive area, showing a little bit of an improvement here above its 50-day moving average, but has been chopping sideways lately. And energy, we don't know if this is defensive or offensive for right now. It just cannot seem to get above its 50-day moving average, but the momentum and the relative strength are showing some improvement. Then looking at the 10-year yield, it was up, which means that the 10-year based on price was down, and that pressured stocks. But the market is still anticipating this soft landing. We're still well above the rainbow when we look at stocks compared to 3 to 7-year bonds. And this is an inverse of that same chart, showing how bonds are underperforming, and we want to see this continue to go down to be positive on stocks. We look at 1 to 3 month T-bills and compare it with 3 to 7-year. This is going back up, and that means there's inflation and interest rates worries that are coming back into the market. We look at the S&P 1500, a broad market measure, and compare it with shorter-term 1 to 3 to 7-year bonds, still holding up and above the rainbow. This is a broad market measure, another one, but looking a little further out at 3 to 7-year bonds, still holding up quite well. Tips to 7 to 10-year treasuries, this is going back up. That means there's inflation worries and interest rate worries that are coming back into the market. We look at 1 to 3-year bonds, compare it with 3 to 7-year bonds. This had been coming down. Now it's starting to go back up. So we're seeing a lot of confirmation that there's some interest rate concerns coming back into the market, even more prevalent than they were. The Qs to 3 to 7-year bonds still has the Qs outperforming. The tech sector still outperforming 3 to 7-year bonds. This is a bit of a concern. We're really coming down when we compare home construction to 3 to 7-year bonds. It's just going deeper, deeper, deeper into the rainbow. Now, earlier in 2023, we came all the way down to this 250-period moving average. Is something like that going to happen before we bottom and then see a bounce up with this ratio? Just something to watch for. Eurozone kind of having some problems in France. There was an election over the weekend, and the the people that weren't supposed to do good did good, and the people that okay, anyway, it's really kind of hard to their system, their governmental system and their election system is so different from the US. But there's going to be another election coming up this week on the 7th. And so this whole process that's going on has not finished yet. And that's been dragging specifically parts of the European market down, depending on what day it is. Some day the markets bounce up, other days they go down. But overall, when we compare the Eurozone altogether with 3 to 7 year bonds, it's coming back up, but this has been showing some recent weakness. And then we look at our growth to value ratios, looking good with Qs to the S&P, coming down, but not really showing much of an improvement with discretionary to the S&P. Large cap growth is still outperforming large cap value. So with the large caps, we're hanging in there, but where we're not seeing any follow through is with the mid caps and the small caps. We're turning more negative here with our 19-day advanced decline ratio. We're dropping further below zero based on price, and we're just barely positive here based on volume. This still continues to go up, the S&P to utilities ratio, and that is positive for the time being. This ratio continues to go down, and that's also positive for the S&P when we compare staples to the S&P itself. So what's our outlook for Tuesday? The stock market will close at 1 p.m. Eastern time on Wednesday, and then it's going to be closed all day on the 4th of July for Independence Day. We are still positive. These negative divergences are still there, and weakness is coming into the market. Instead of putting a question mark there, I'm making more of a statement until proven otherwise. We're going to get the JOLTS job openings. That's the only thing coming out on Tuesday, and then all the crazy stuff that's going on geopolitically. I have France on the list right here. And then Wednesday, we're going to get this whole slew of economic reports, but the market closes early. Hour after the market closes is when the minutes are supposed to come out. I mean, is that how they're going to do this whole thing? And then we'll be closed on Thursday, and then we're going to get two major reports on Friday. So Fed Chair Powell will be giving a speech on Tuesday, and we're going to get the JOLTS job openings. Seasonality, we're negative with the Dow on July 2nd, where we're neutral to negative with the S&P and NASDAQ. And we're not seeing really all that much during an election year. Not anything really falling apart. A little bit of positive seasonality here from day 2 to day 3, which is a little bit different than the historical numbers we just looked at. And Tuesday is kind of a flip of the coin, whether it's going to be an up day or a down day. Looking a little further out, we are coming into a period of time when we do see a longer-term uptrend during the summer months. Also, Stock Traders Almanac has said from the end of June into the early part of July, this tends to be a good time for the NASDAQ, and it's living up to it for right now. It's at a new all-time high. But we look at this purple pinky line here and how far away it is from the green line, and they're very far away from each other. Are we going to see some kind of reversion to the mean, so to speak, as things have gone up pretty far, pretty fast? This is also for the month of July, going back each election year to 1950. It's 50-50. We're up 9 out of 18 times, down 9 out of 18 times with a return of 0.7%. And then we take the month of July and look at it during different time frames. Since 1950, that's the yellow area. The past 20 years, that's blue. The past 10 years, that's green. During an election year, that actually performs the worst. But all of these are positive. And then taking another look at these 3 months, we're already out of June. We're coming into July, and here are the returns on a historical basis in August. The warning signs, we have now turned negative with the parabolic SAR. We're watching the utilities, staples, energy, and healthcare. Those are the more, energy is the real variable because sometimes it's not necessarily defensive. But if there is a kind of a pickup in the Middle East between Hezbollah and Israel now, there might be a shift going on from focusing on Gaza to looking at Hezbollah. And Hezbollah is a lot bigger and has a lot more powerful weapons. So that could escalate things. And that might be having some kind of an impact on oil specifically. The advanced decline lines are showing weakness right now. The growth to value, at least for the S&P, is improving, but we're not seeing that across the board. Where discretionary to staples, they're just not leading right now. And the NYSE as well as S&P 500 McClellan oscillators and summation indexes, they are now negative. Both are negative, where we saw a mixed picture after Friday. The Swenlin trading oscillator is now negative, and our oscillators are turning negative. The money flow index is turning negative. The QQQ weekly chart, I didn't show that this time. We don't really know if it looks all that scary yet or not. But the momentum for the NASDAQ 100 is now turning negative. And then on the positive side, we do have our three smart money indicators that are positive, but every one of them is currently declining. And the equity put call ratio is now going down, which is positive. The bullish percent index is above 50, but declining. The ultimate oscillator has turned back positive after being negative for 1 day. The vortex is positive, but declining. The copy curve has now turned negative. I should have thrown that over on the other side. And the Pring bottom fisher has generated some kind of a buy signal out of nowhere. The financial sector is positive, and the bullish percent index for the NASDAQ 100 continues to be positive, even though it ticked down. So our conclusion, we're positive, but weakness is coming into the market. Market's going to have to take care of this at some point if we're going to remain positive. This could also lead to more of a decline if this weakness isn't dealt with. In the short term, we're positive, but we're just not showing any strength right now. In the intermediate term, this is where we're seeing more of the weakness starting to develop. We're still positive in the long term, even though we have those longer term negative divergences between the 150 and 200 period moving averages. Thank you. I hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.